Okay, money management. Money management is a very important step to have in order to profit consistently over the long term. So with that in mind, let's take a look at what we'll be covering in this lesson. First, we're going to go over the introduction of money management, and then the principle of money management, risk to reward ratio, and then the lot size calculator, which is the tool we're going to use for your money management. Introduction. Money management is a must step before entry. Every trade enter must follow a strict money management rule. Before entering each trade, you must know your risk and the potential reward of the trade beforehand, which is your risk to reward ratio. Okay? Money management is a crucial part to achieve consistent profits in Forex trading. Without it, no matter how amazing your trading skills may be, you will lose in the long run. Be very disciplined when it comes to money management. It's the iron rule. Follow through on each and every trade. No questions asked. Okay? Now, the principle of money management. Forex market is a very volatile market. Anything could happen. As a professional Forex trader, you are not a gambler. You are here to risk a calculated amount of capital to gain something much greater in return. Your goal is to live to trade another day. So don't put all your money in one trade. That's gambling, not trading. You want to spread out your risk among your trades, not pour all your risk, all your capital in one trade, and what happens that trade turning to be a losing trade? You lost everything. You waste all your bullet in one shooting session. That's not a good idea. That's not very smart. That's gambling, right? Now, always try to minimize your risk first before try to maximize your profit. Now, this is a common mistake for new traders. People always think about, oh, how much I can make in this one trade, how much profit I can stretch out for. People always focus on how much they can make, but they're looking to the wrong direction. What they need to focus on is how much risk they can minimize first. How much risk they can minimize first, before consider how much profit they can maximize. Okay, always think of in terms of risk management. The true nature in any kind of trading is risk management. All the professional traders know they have to minimize their risk before consider maximize their profit. So keep that in mind. Okay? Do not try to avenge the market by double down your stake if you repeatedly lost your trades or your stop loss has hit before market went into a direction. If that happens, don't double down. That's gambling. I know you're angry, you're frustrated, especially when market took out your stop loss, then market going to your direction. Your analysis is all correct, but market is very unpredictable. Sometimes it will do this. But don't try to double down. Go with your money management rule on each and every trade. You will make back because your reward is often bigger than your risk. Okay? Don't be an emotional trader. By doubling down as an emotional trader, wait patiently for another opportunity to show up. Remember the phrase, opportunity is just around the corner. Don't worry. It will come. Okay? Now here's the money management rule. Only risk 2% of your account capital in any one trade. Sometimes if you're very confident with the trade, you can risk 3% or 4% of your account in that trade, but no more. Okay? 2% is a normal amount people will risk. But sometimes maybe you feel more comfortable with only 1%, you can do that. If you feel very confident with the trades, you can risk 3%. That's okay too, just a little bit more. But the idea is, once you set your percentage, keep it consistent with every trade you take. Don't try to change around too often. It's not a good idea. The second rule, don't risk more than 6% of your account in total open trades in any one time. So if you're risking 2% of your account per trade, you can only have 3 open trades at any given time. The reason we have the second rule is because we want to make sure you don't have your total exposed risk being too big. If you want to conserve your bullets, you want to live to trade another day. In case it turned out to be a losing trade, you still have the capital to come back. Okay? Now the number 3, always follow the money management rule anytime you place a trade. No exceptions. Okay? Be very disciplined with this money management rule. Now the risk to reward ratio. Before entering into a trade, you must know your risk to reward ratio for that trade. Your risk to reward ratio should always be greater than 1 to 1. Otherwise, it's not worth entering a trade if you can only get back less than what you have risked. Imagine if you risk $100, the maximum you can get back is $50. You're better off just don't invest. You're better off just keep the $100 and don't trade, right? That makes sense. You only trade because you think by trading you can get greater than 1 to 1. Okay? This is not gambling. So in gambling, your expected return, which is your risk to reward ratio, is often less than 1 to 1. Think about blackjacks. Even you using the basic strategy and you play every hand perfectly, the house edge still has about 0.5% to 2% over you. Your expected return is 1 to 99.5% or 1 to 98%. Meaning that if you play in the long run, you can expect to lose 50 cents to $2 for every $100 you wager. That's why casino makes money. Okay, and the odds are not in your favor from the start. The moment you walk into the casino, any game you pick or you choose to play, the odds are always on the house side. The house has edge over you. But we are not gambling out with our money. We only trade Forex when there is opportunity that's in our favor, and our risk to reward ratio is greater than 1 to 1. Right? Now here's the example of risk to reward ratio and trading. Let's say you only take 1 to 5 risk to reward ratio trades. Let's say the first trade you entered, it was a loss. Okay, you lost -1. The second trade you entered, it was a loss also. You lost another -1. The third trade you entered, it was a loss again. You lost another -1. The fourth trade, you were very careful, but you still lost minus another 1. But the fifth trade you entered, it was a win. And in that one win, you won +5. Subtract the first 4 losses minus 4, you still gain +1. So overall, you're still profitable. Obviously, with our method, you're not going to get so many losses. The most you get probably at second loss or the third loss, but the fourth one, the fifth one, you're winners. So the fourth one, the fifth one, that's +10. Each has 1 to 5 risk to reward ratio, +10, minus the first 3 losses, that's -3. You still +7. If you risk 2% per trade, 7 times 2%, that's 14%. So in 5 trades, you just made 14% if you count. That's pretty good, right? That's pretty good. Now, this is also a great example showing that by taking a very good risk to reward ratio trades, even you have repeated losses, but as long as your risk to reward ratio is big enough, one win will eat up all the losses before. Put you in a very good position, put you in a very good shape. Okay? Now here's the breakdown. Okay, if you risk 1 to 1, you need 50% wins to break even. If you're risking 1 to 2, you need 33% wins to break even. Risking 1 to 3, you need 25% wins to break even. Risking 1 to 4, you need 20% to break even. Risking 1 to 5, you need 17% to break even. Now most of our trades were somewhere between 1 to 2, 1 to 3. Okay, sometimes between the low end, it will be something around 1 to 1.5 or 1 to 2, somewhere in this range. Okay, we will also get 1 to 4 risk to reward ratios or 1 to 5 risk to reward ratios. Those are really good ones. But most of the trades, it was somewhere in this range. Okay, remember we talked about in the support and resistance lessons that in any given time, there's only 3 situations in the market. Market is either in an uptrend, downtrend, or it's in a ranging market. Since we don't trade in a ranging market, then the market is either in an uptrend or downtrend. By picking one direction and sticking to one, you instantly raise your success rate to 50%. And with other technical analysis tools, you increase your 50% to something even more. Now just think about this. 50% is already greater than 33%, and 50% is already greater than 25%. You only need 33% to break even, or 25% to break even, by having a 50% success rate, 50% win, whatever the difference is your profit. whatever the difference is your profit, because you only need this percentage to break even. Whatever is greater than this number is your profit. So now you can see why risk to reward ratio is so important. You have a strategy and you have a money management. Combine the two, you can make money in the long run. Okay. Now, how to find out your risk to reward ratio? Before considering each trade, you need to know 3 price levels: your entry price, your stop loss, which is LSL, and then your target profit, which is TP. Okay. Once you know those 3 price levels, use WFJ's Forex Lot Size Calculator. Not only you'll know your risk reward ratio, also you'll know just how many lots you need to enter for each trade. Because the Forex Lot Size Calculator are based on the percentage of your total account capital, combined with your 3 price levels that calculate the lot size for you. Okay? Now the lot size calculator. Here's just a screenshot of it, but you can go to WFJ Lot Size Calculator tutorial in the members area for more information, and you can download the calculator and watch the video tutorial on how to use it. Here's just a screenshot. I'll just go through it really quick. Once you download the calculator, first thing you want to do, you want to update this account balance, your current account balance, to reflect your current account. Okay, and here you can see it's by default it's risking 0.02, which is 2%, risking 2% of your capital. Each trade money amount is at risk is $200. Okay, this is your money amount. And then the 3 price levels which you want to put in is current entry price. Type in here. This the bottom one, it was the same. It will equal the first one. So you just have to type in the first one here. And then the stop loss is here. Target profit is here. Risk to reward ratio will automatically calculate. This pips difference will also calculate. Okay. Now you can see risk to reward ratio over here. And then here's the lot size you need to enter for your trade. Okay, it will show up here. And then the dollar amount in rewards will show up here. Okay. So hopefully with this lesson, you understand money management is a very important part in Forex trading, and it should follow with extreme discipline. Do not change it once it's set, and follow it through every trade. And I hope you understand, in our trading, we combined the high probability of successful trades, which means you only enter a trade when the odds is in your favor, okay, plus the correct money management rules. Every trade risk to reward ratio must be 1-to-1 or greater. Okay, combine the two together. That's how we achieve consistent profits. Okay.